Good morning, everyone, and welcome to our self-directed IRA and solo 401k Q&A session. My name is Natalie with Sense Financial, and we will start answering questions shortly. But if there are any additional questions, I would like to encourage you to submit them in the Q&A chat area, and we will go ahead and answer them today. Our speaker today will be Dmitriy, and Dmitriy Fomichenko is the president and the founder of Sense Financial, a boutique financial firm that specializes in self-directed retirement accounts with checkbook control. He began his career in financial planning and real estate investing in 2000, and he owns multiple investment properties in various states, and he is a licensed California real estate broker. Dmitriy also holds the designation of Certified IRA Services Professional from the American Bankers Association. And over the years, he's taught hundreds of investment and financial planning seminars, and he's mentored thousands of investors. So welcome, Dmitriy, and thank you for joining us today.
Thank you, Natalie. Just want to make sure I'm mute and my camera is on. Welcome, everyone.
Awesome. So we are going to go ahead and just dive into answering the questions. Our first question is from Donna. What bank do you recommend for your checkbook IRA?
Well, Donna, we use Solera National Bank as an IRA custodian. They will also provide you with the free checking account for your checkbook IRA. So it will be with Solera National Bank.
Okay, this next question is also from Donna. Does IRA LLC pay taxes?
Well, Donna, let me break that down for you. The checkbook IRA in this case, or IRA LLC, is a single member special purpose LLC. The single member LLC does not pay income taxes on its own. It's passed on to the member. And the member in this case is the IRA. And IRA is tax deferred retirement vehicle. So it will not be responsible for taxes. Taxes will be tax deferred or tax-free in case of a Roth IRA. But there is a caveat: if you use your IRA LLC to invest in some kind of a business activity, maybe flipping or wholesaling, or if you otherwise invest in an active business, there might be UBIT implications. And UBIT stands for Unrelated Business Income Tax. And that is a tax that is assessed on tax-exempt entities that engage in a business activity. So you want to be sure to check with your CPA if, again, you engage in a business activity or IRA otherwise generates earned, not passive income. All passive income from passive investments will be sheltered from taxes.
Okay, one more question from Donna. Can I partner with my IRA LLC?
Donna, remember that you are a disqualified person to your IRA, and per IRS rules, all transactions must be arm's length, meaning that there is no disqualified person involved. Under some circumstances, it might be possible to partner with your qualified retirement account, but in most instances that will not be allowed, and most likely will be considered a prohibited transaction. One question that comes up often, or probably the number one reason why people do want to partner with the retirement account, is because there is not enough money to make the investment on your own. And so if you're going to do that one way or another, then you're actually enabling your IRA to participate in a transaction that IRA will not be able to participate in the first place. So that is providing some material benefit, and again, that will likely be construed as a prohibited transaction by the IRS. So we recommend not to do that. And what you can do, you can actually use your IRA to partner with somebody else who is not a disqualified person. If you buy an investment property, IRA can get a loan, so you can use leverage. But feel free to schedule a consultation and we can talk about your specifics and make sure you're doing things correctly.
Okay, next question is from Mary. Where do I get checks from? If I have been paying expenses myself, can I pay myself back?
Good question, Mary. Where do you get the checks from? Well, you get the checks from your bank, and where you have a checking account. You request your bank, and they can get you checks or checkbook. You can also use bill pay. That's a convenient way to pay for the expenses that are directly related to the investment of your retirement account. So to answer your second question, if you have been paying expenses myself, can I pay myself back? Well, all the expenses that are directly related to either IRA or 401k investments that the qualified retirement plan owns, they must be paid from the retirement account. You cannot pay those expenses yourself. That will be a violation of the rules. And so you cannot reimburse yourself either. All the expenses must be paid from a retirement account. What will be acceptable is for unrelated third party to possibly pay the expenses. Example can be if you have a property manager, your property manager can pay for the repairs on your rental property that your IRA or 401k owns, and then you can write the check to reimburse the property manager for those expenses. But you personally yourself cannot pay those expenses, nor can you reimburse yourself.
Okay, next question we have here is from Robert. Can you have a relative as an employee with a self-directed solo 401k?
Robert, your question is a little bit unclear. Are you asking about employee in your 401k? If that is what you're asking, your solo 401k plan cannot have employees. It's not a business. Your solo 401k plan is a qualified retirement vehicle. It can only make investments. So you can have employees in the 401k. If you're talking about the sponsoring business that you use to sponsor a 401k, remember it's actually relevant whether the employee is relative or not. There are certain criteria that you must meet. Solo 401k designed for those who own a business or are self-employed and have no full-time employees. So number one, you cannot have a full-time employee, again, regardless whether it's relative or not. That excludes your wife, by the way. So your spouse can be employed by the business and can also participate in a solo 401k. So, but there cannot be any full-time non-owner, non-spouse employees. You can have part-time employees, but you gotta remember to the threshold, and that threshold is 1,000 hours for part-time employees. And if there are any long-term part-time employees, meaning that part-time employees who work for you more than 3 years, then that threshold drops to 500 hours a year. So you gotta make sure they're under that threshold. If they're over that threshold, then you will not be eligible for a solo 401k. But again, Robert, feel free to reach out and we can talk about your specifics.
Okay, this question is from Lorraine. Can I invest in Fundrise with my solo 401k?
Can you invest in a Fundrise with your solo 401k? Yes, you can. You can use your self-directed solo 401k to invest in virtually anything. The only exception will be collectibles. So anything that is considered collectible, IRS does not allow you to invest using your solo 401k. In addition to that, you're not allowed to invest in any transaction with disqualified person, and that is yourself and your immediate family members. So other than that, you can invest in virtually anything. Certainly, yes, for a Fundrise.
This question is from James. Is there a recommended way to take IRA distributions to limit the tax?
James, good question, but it is a good question for a CPA. I'm not a CPA, so I can't give you a tax strategy, and plus I don't know your tax situation. I'm sure there are ways to minimize your tax liability and create a strategy for that, and it's important to plan for it in advance, but that's something that you got to discuss with your CPA because again, that's a tax question. I'm not qualified to give you tax advice.
Okay, our next two questions are related, so I'm going to go ahead and combine them. These two questions are from Danny and Thomas. Which form do I use to report solo 401k holdings? And I would like to make sure I understand all of the IRS required filings.
Solo 401k has some of the reporting requirements. There are a couple different requirements that you need to understand. And some of them you're responsible for, the other we're responsible for. So what we're responsible for is to do annual sponsor reporting. And that is something that we, as the document sponsor, submit report to the IRS annually each January. We report your plan as active to the IRS. IRS obligates us to do that as your document sponsor. What you're responsible to do is you're responsible reporting any contributions that you make to your solo 401k, and those contributions are made on your tax return, either personal or your business tax return. So that depends on the type of business that you have. If you're sole proprietor, then your elective deferrals will be reported on a Form 1040 of your tax return, and then profit sharing contributions will be reported on Schedule C. If you're incorporated, then same thing, the elective deferrals will be reported on Form 1040, and then your profit sharing contributions will be reported on the corporate tax return, which you will file separately. So your accountant will guide you on that. Those are very standard and very straightforward. Then in addition to that, you are required to submit annual report using a form 5500 EZ. This is a short form, only 2 pages, and you're required to submit that form if your plan assets exceed $250,000. Now remember, this is total plan assets for all participants and all the accounts, so you have to sum everything together, and if that number exceeds 250, you're obligated to submit that form. We actually recommend getting into a habit and submit this reporting regardless of your total plan assets. This is just a good practice, plus you get the statute of limitation going with the IRS. But again, it's a simple form. We do provide assistance with that, and we send reminders when it's due.
Okay, this question is from Tom. How can you make sure of the safety of buying a real estate note?
Tom, how can you make sure safety of buying a real estate note? Well, this is an investment question. This is not a question related to the 401k. So, but I can answer that just generally speaking, because I'm a note investor myself. I do invest in notes, and your real estate note is secured by real estate. So that's what the safety is. You have to do your due diligence ahead of time. You have to look at the underlying property that is securing the note, and that is your safety. To give you an example, if you're lending $60,000 on a property that is worth $100,000, well, you got $40,000 of equity protecting your interest. So the property itself. So that's, in my opinion, that's a pretty safe way to invest. But we actually did a couple different webinars on this topic recently. So you can find us recordings on our YouTube channel or on our website, and you can learn more about investing in notes by watching the recording.
Okay, this question is from Chris. He would like to know more about combining outside company match with solo 401k.
Chris, your question is a little bit unclear. Are you talking about combining your 401k that you have with your employer outside company and they offer a match with your solo 401k? If that is what you're asking, then the answer is no. You cannot combine your 401k that you have with your full-time employer with your solo 401k. Those are two separate plans. Under certain circumstances, you might be able to roll over, again, if eligible, your employer 401k into solo 401k. That's the only way you can combine those assets together. But you can combine company match, because company match goes to your employer 401k, and your solo 401k doesn't have a company match. It does have profit sharing contribution, and perhaps that's what you were referring to. If you're talking about profit sharing contributions with that you're making to your solo 401k with your elective deferrals, then yes, those can be pulled together and invested together.
Okay, this question is from Frank. With tax cuts going on through 2025, what are your thoughts on Roth conversions?
Frank, good question about the Roth conversion, but this is a question that I cannot answer because it's very individual question. And the reason is whether it makes sense for you to do a Roth conversion or not depends on a number of different factors. Certainly, any type of tax deductions that are available from the current legislation is important, but you also have to look at your overall financial and tax picture. Just a few things to think about and to discuss with your CPA. What is your current tax bracket? What is your possible future tax bracket? What the impact the Roth conversion will make if you were to do a Roth conversion now. And then also you need to consider if you're going to be making a Roth conversion, what your age is, how much time you have for the Roth money to grow tax-free for you. Generally speaking, the younger you are, the more sense it makes to do Roth contribution or Roth conversion. But you also have to consider the possible investments you're going to make with your Roth account. If you're able to generate higher rate of return, then yes, it also will make sense to do Roth conversion because those gains and profits and growth and investment will be tax-free at the end. But again, something that you want to get with your CPA and discuss if it makes sense for your particular circumstances.
Okay, this question is from John. Can you have a self-directed plan tied to your business as well as one tied to another company?
Yes, John, you can have a self-directed solo 401k plan set up for your business. And if you're employed elsewhere and you have a 401k offered by your employer, then you can have both. You can have more than one 401k plan and you can make contributions to both. But with one caveat, while solo 401k total contribution limit for this year is $66,000, it comprises of two components: the elective deferrals, which is what you contribute as an employee. That limit is $22,500 for this year, plus profit sharing contributions. So combined total again is $66,000. But the elective deferral contributions are subject to a single limit for all the plans. So if you have a 401k with your existing employer and you already maximized the contribution as the employee there, if you already put in 22.5 as an employee there, then you're not going to be able to contribute anything as an employee, elective deferrals in your solo 401k plan. You can still do profit sharing contributions, again, up to $66,000. You just won't be able to contribute any elective deferrals.
Okay, we have a question from Joe. Can we use plan funds to reimburse the plan setup costs?
Joe, I'm not sure which plan are you referring to. If you're talking about solo 401k plan setup, then no, the responsibility to pay that, it's considered settler expense, and your business will pay for the setup cost to create a solo 401k plan, and that is a tax deductible business expense, so it only makes sense. If you're talking about IRA plan, it is possible to use IRA funds to pay for the setup cost. Contact our office. There's a certain way to do that. Contact our office. We can help you with this. But you cannot reimburse yourself. Again, it needs to be done correctly because you're a disqualified person. So, but your plan can pay directly for the setup cost. So again, there is a way to do it. Give us a call.
Another question from Joe. If material or repairs are needed, can we use a personal credit card and pay that bill from plan funds?
I think this question can be answered regardless whether it's an IRA or 401k. And all expenses that are directly related to the investments that qualified retirement plan owns, again, whether it's an IRA or 401k, those expenses must be paid from the retirement plan directly. You are prohibited from using a personal credit card to pay for those expenses. That will be a violation and will disqualify your plan. And you're also not allowed to provide any kind of reimbursement or pay that bill from the 401k. Again, the expenses must be paid directly from the plan, not the credit card bill. And let me expand on that a little bit. Another question that often asked is, can you have a credit card with your solo 401k or even checkbook IRA? And the answer is no, because credit card will require a personal guarantee, and you're not allowed to do so in a qualified retirement plan. But what you can do is you can actually request a debit card, because you do have a checking account for your solo 401k or checkbook IRA. You can have a debit card, and you can use a debit card to pay those expenses, just like a credit card. Although you must be very careful, and you can't carry that in your wallet, because if you accidentally use that debit card to pay, for gas, for example, that will be a violation. You'd be breaking the rules. So you got to be very careful not to commingle the funds and not to make mistakes like that.
Okay, this question is from Paul. How can I use my Schwab self-directed IRA tax-free for trust deed investing?
Paul, if you have a Schwab IRA, then it is not a self-directed one. They might call it a self-directed, meaning that, and what their meaning is different than what the truly self-directed is. They might call it a self-directed IRA, and what they mean by that is that you can pick Schwabs, you can buy those stocks or do the trading inside of your Schwab account yourself. That's what they mean self-directed, but you don't have the ability. Schwab will not allow you to invest in any alternative assets. You can't invest in a trust deed with your Schwab IRA. You do need a self-directed IRA with a custodian that allows alternative investments. And again, if you wanted to have a checkbook control, then we can set you up with the IRA-owned LLC or IRA-owned trust that will give you a checkbook control over your retirement funds. And then you can make those investments yourself without a middleman. But again, if you have a Schwab IRA, that is not a truly self-directed account, and you can only invest in the assets or investments that are offered by Schwab. Think of it this way. Picture a tank, the fish tank. Some of you maybe have one, or I'm sure have seen one. You have a fish tank. The fish has the freedom to swim within the boundaries of that tank, but there are walls. And so fish cannot go outside those walls. But that's what your Schwab IRA is. Now, what if we took that fish tank, you brought this to the ocean, and you dump that into the ocean? Well, now the fish has the freedom to swim really wherever it wants to swim. So, and that will be an illustration of a self-directed IRA. Hope that makes sense.
Our next question is from Sam. I got a property in my self-directed 401k. 50% is owned by non-recourse loan. Can I pay the loan and own 100%?
Sam, if you have the property in your self-directed solo 401k and you have loan on 50% of that, that doesn't mean that your lender owns the property. You own the property 100%, even if there is a loan. Yes, there is a loan for 50%, but you do own the property 100% to begin with. So that's a clarification. I think you had misunderstanding there on the ownership. Again, ownership is 100% by your solo 401k. But if you do have a non-recourse loan and you have money in your 401k and you want to get rid of that loan, you sure can pay that off. That's something that you may want to talk to a lender to see if there's any perhaps prepayment penalties, but I'm sure most non-recourse loans can be paid off. And this way, then you will own 100% of the property, or continue to own 100% of the property, but now it's going to be free and clear. Before it was financed, now it's going to be free and clear. But the ownership doesn't change when you pay off the loan. Hope that clarifies this for you.
Okay, our next question is from Dinesh, and he would like to know about the tax implications of solo IRA and checkbook IRA.
Tax implications. I think we talked about this in one of the earlier questions. Again, if there are if you're making any investments in an active business, or there is an active earned income that is generated inside of your retirement account, there will be unrelated business income tax that will be due. In addition to that, if you use an IRA, that doesn't apply to a solo 401k. If you're using an IRA to finance a purchase of an investment property inside of that IRA, then portion of the income that is derived from the financed portion of the property will be subject to UBIT. That income is designated as UDFI, and that stands for unrelated debt finance income. So that income is, the taxes apply to that type of income inside of an IRA. But 401k is exempt. If you finance property inside of a 401k, there is no UBIT implications. But again, the only thing that you need to be aware of is if you invest in some kind of a business activity with your retirement plan. But if you're asking about taking a distribution from your IRA or 401k and paying taxes on that, yeah, that will be considered ordinary income, and ordinary income tax will apply. That's something that you wish to discuss with your CPA.
Okay, next question is from Songwook. I would like to invest in real estate note investment using money kept in a traditional IRA. Is my plan allowed to invest in notes?
If you'd like to invest in the real estate investment using money kept in traditional IRA, well, I don't know what type of plan you have. You didn't clarify here, but if you have a self-directed plan, meaning there is no restrictions on the investments by the custodian, then yes, you can certainly invest in real estate notes, real estate directly, and any other alternative investments. If you have an IRA with a conventional custodian such as Schwab or Fidelity and so on, then you won't be able to do alternative investments there. But if you have a self-directed plan, you can certainly invest in notes. Again, we've did a couple of webinars over the last few months on this topic. Check our website and also check out our YouTube channel. You can find those recordings or reach out to our office. We can send you the links for those, and you can learn more about investing in notes with your self-directed retirement plan.
Okay, next question is from Tara. If I have a legal fee to pay for a Roth investment in the solo 401k, do I have to use Roth funds to pay for it, or can I use pre-tax?
So if you have a self-directed solo 401k plan and you have a pre-tax account there, and you also have a Roth designated Roth account, and your Roth holds the investments, and then you incur a fee for that investment, then it must be paid from the Roth, because that is, you cannot commingle, your Roth and pre-tax funds. You got to keep them separate. So if there is an expense for the investment that is directly related to your Roth, has to be paid from the Roth funds.
Okay, question from Dan. How to take RMDs from my IRA trust if I only have a property in it and not enough cash?
Dan, if you're due for RMD, which is required minimum distribution, and if you don't have enough cash and just the property in the account, that indicates that there is a lack of planning for it. One very important piece of advice that I can tell you, again, if you're approaching RMD age, which is, I believe, 73 now, it's due to increase to 74, I believe, soon. But if you're in your 60s, right, then you got to start thinking about RMD at that time. Start planning for it ahead of time. Run some numbers. See what the RMD you're going to have to take, and think about how you're going to be taking that. Are your assets producing enough income? So if you have an asset and it doesn't produce enough income and you fail to plan for that ahead of time, then there is a few things that you can do in that case. You can sell the property to convert it to cash, and now you can take RMD. You can possibly sell a portion of the property to unrelated third party, so you can now own portion of it, and now you have enough cash to satisfy the RMD requirements. And then a third option will be to take in-kind distribution. In-kind distribution meaning that you're taking the property out instead of taking the cash. So the property will have to be appraised to determine the value of the property, because it is a taxable event. You need the independent third-party valuation on the property. And you can take entire property out, or you can take portion of the property possibly. That will be rather complex, because let's say prior to the distribution, your IRA owns 100% of the property. And then after the distribution, your IRA owns 80%, and you personally own 20% of the property. So now you have to split everything accordingly. you can commingle those funds, and you probably need a third-party property manager to handle everything so that there is no commingling. It is possible, and you can do it over a period of few years. But again, the key is to plan ahead of time for this. Be prepared.
Okay, those were all the questions that were submitted. We do have a question here in the chat. For all of our attendees, if there are additional questions, please don't hesitate to ask us. But this question is from Shannon. I have a solo 401k with my financial advisor, but it doesn't offer as much flexibility. Plus, there are sales fees. I also have an account set up through you. Can I fund and maintain both accounts as long as the combined contribution doesn't exceed the maximum contribution?
Before I answer a question from Shannon, I just wanted to reiterate what Natalie said. If you guys have questions, this is your last opportunity to type them. And remember that those who are attending here or those who are going to watch the recording of this can also learn from your questions. Again, I always encourage my clients, if you're not sure about doing something, go ahead and ask. So if there is any lingering questions, you guys go ahead and type them in a Q&A and we'll address them. But this is our last question for today. Shannon is asking if it looks like she has a 401k or solo 401k with the financial advisor and also through us. Well, you cannot have two solo 401k plans. If you have a business, you cannot have two solo 401k plans. You may have a checking account for your solo 401k that you do alternative investments with, and you also may have a brokerage account with your financial advisor, but it's under the same plan. That is okay, but we need to clarify here what's unclear for me, Shannon. If you have two separate solo 401k plans, because you can't have two 401k plans. So we be sure to reach out to us so that we can clarify what it is that you have and make sure that you are in compliance. But you can have both accounts, just not two plans. So that will be my advice to you.
We do have one more question from Jane. How does UBIT work in a solo 401k and Roth IRA that invests in a syndication?
Good question, Jane. What are the UBIT implications when investing in syndication with solo 401k and an IRA? First, let's talk about solo 401k. If you use your solo 401k to invest in a syndication, there are no tax implications. There is no UBIT implications because it is a passive investment, and there is no UBIT implications on leveraged real estate. Now, if you invest in a syndication using your self-directed Roth IRA, there probably will be some UBIT implications because most syndications, they do use leverage. And when you use leverage inside of an IRA, that leverage will result in UDFI, unrelated debt finance income. And UDFI is subject to UBIT. You may say that you don't own real estate directly, so there is no leverage. And that's true, but you do own a portion of one big asset, and there is leverage on that asset. And so you proportionally will own a portion of that asset with the debt attached to it. So there will be UBIT implications, and that's something that you do want to discuss with your CPA. But yeah, that's something to be aware of.
Another question from Bill. Is there a way to take advantage of depreciation in a real estate syndication that the solo 401k invested in?
Good question from Bill. Is there a a way to take advantage of the depreciation when investing in syndication with a solo 401k plan. And the answer to that is this. When you invest in any investment, including syndication, using your self-directed solo 401k plan, solo 401k is a tax-deferred vehicle. Depreciation is used to offset your personal taxes. But when you invest using a solo 401k, there is no taxes. The investment is sheltered from taxes. So there is, it's a moot point because you're not paying any taxes on any income inside of a solo 401k. When you invest using a self-directed IRA, and this is a question actually very related to the previous one, when you invest using a self-directed IRA, whether traditional or Roth, in a syndication, most likely that will produce or will result in unrelated business income tax. That is actually when you can use the depreciation to offset that tax, because you can take the portion of the deductions, all the expenses, including depreciation, you can offset that UBIT tax inside of an IRA. Hope that makes sense.
Okay, looks like those were all the questions, which brings our session to an end. So thank you everyone for joining us today. I just want to mention that our next session is going to be on December 4th. It's Monday, it's at 11 a.m. Pacific Standard Time. So we look forward to you joining us then. And please don't hesitate to ask any questions. If you have questions in the meantime, feel free to reach out to us. We can set you up with a consultation and help you out that way. But once again, thank you for joining us, and hope you all have a wonderful day.
Thank you, Natalie, for a great job hosting this, and thank you for all the attendees. I enjoyed answering your intelligent questions, and looking forward to seeing you all next time. Enjoy the rest of your day.